All right, we are live. Welcome back to another episode of Punch Card Capital. We have a new guest today, CJ. How you doing, CJ?
Hey, I'm doing well, Brad. Thank you.
Awesome. Yep, Frank couldn't be with us. It's the lady's birthday today, so he's out with her. And then Jack is attending a wedding today, so he couldn't be here either. But we've got an action-packed episode. We're going to be talking about Nick Sleep's Nomad Investment Partnership Letters, the first year of that, which was 2002, kind of the latter quarter of 2001 into 2002. And yeah, we'll just roll with that. So, did any of you have anything that really jumped out from the first year of these partnership letters that you wanted to kick things off with?
Well, I mean, the guy was buying Costco in 2002. That's always a good recipe for success, right?
Right off the bat, yeah, right out of the gate, yeah. They got Costco pretty quickly.
Yeah, have any of you guys looked deep into Costco before?
Not as much. No.
Yeah.
Just what Charlie Munger said. Yeah, Charlie's owned. I wonder how long he's owned it for. I've never looked that up, but yeah, I did a bit of a dive into Costco, just kind of looking at it through the lens of how Nick Sleep was looking at it in 2002 to see, where does it compare in terms of value today versus 2002? And it is nowhere near where it was in 2002 on like a free cash flow basis. So, which is no surprise considering what Costco has done over the last 2 decades. But yeah, I really appreciated just how Nick Sleep broke down his investment case for Costco. I thought it was just really sharp and enjoyed digging through that.
We get into that in the 2004 letter, right? I mean, that's still like he really gets into Costco later.
You're right. That is 2004. Yeah, I jumped ahead there.
Yeah, it's more about Stagecoach and International Speedway.
Yeah.
All those things. Yeah, the initial investment.
The mistake with Monsanto, I was impressed that he actually laid out like a mistake that the company made. Although I don't think they lost money on it, but it was a mistake in terms of something happening that was unexpected with the thesis. One thing that really jumped out at me straight off the bat was they made 18 investments. Like the fund opened the day before 9/11, and by the end of the year, they had made 18 investments in the first 4 months, all over the world. And their framework at this point was really looking for 50-cent dollar bills. And so I was just impressed that they were able to find so many things. I mean, I know they had been working in that industry for a while, so they probably had some things up their sleeve by then. But, no geographical limits in terms of what they were willing to look at.
What do you guys think when they were like measuring themselves against the index? I mean, he said it was not meaningful, but what are your thoughts about like comparing your performance to the index? All of you.
Yeah, I think I'm getting maybe a little bit of feedback from you, Karan. I don't know if the other guys are as well. Yeah, I mean, it's interesting. I mean, in the first, he talks a lot about the Buffett partnership in the 50s. I found he's sort of recommending that his investors give him a sort of a 5-year period minimum for benchmarking, and that allows him to invest sort of as he described it with some sort of competitive advantage where he's got a much longer time horizon than other investors. So I mean, at the end of the day, you've got to benchmark yourself against something, whether it's absolute returns, if you've got some percentage target in mind, I think, or against the index, which I guess is the alternative for his investors. So I think it's a good way to approach it. But yeah, he was definitely trying to get across the message to not benchmark him on that quarter to quarter per se, look at him over several years.
Yeah. One quote that stood out to me from Warren Buffett in 1960, in a letter from Buffett in 1960. I have pointed out that any superior record which we might accomplish should not be expected to be evidenced by a relatively constant advantage in performance compared to the average. Rather, it is likely that if such an advantage is achieved, it will be through better than average performance in stable or declining markets, an average or perhaps even poorer than average performance in rising markets, which, it makes me think of when markets are going crazy, right? When there's these strong bull markets, everybody's always hating on Buffett and Berkshire for underperforming, right? But that's basically the plan, right? It's built into the plan that this is what's going to happen given their approach. So just thought that was interesting.
Yeah, and to go along with that, he kept reiterating, especially at the end of some of the quarterly letters, how please be patient. You have a long time horizon in order for this plan to work out. Because, as you said, in down markets, he's going to be up, and in up markets, he might be down. So, He had the right people with him as well along for the ride. That's one of the big things if you're managing other people's money. I think it's really important, underrated.
Absolutely. And at the end of every letter, he kind of reiterated that for any investors that might have just been coming on. I think that's really important. Yeah.
What do you guys think of the Stagecoach investment? I found that to be very interesting. Shows you the power of management, the founder-led idea and everything.
Mm-hmm. And shows you the negatives of what's Peter Lynch call it? Diversification. And I think he compared it to Coke at one point there too, right? Where Coca-Cola is like this crown jewel business that is so good that the management team, I think, almost run out of ideas of what to do with the capital, so they start buying more mediocre businesses. And I think that sounds like that's kind of what happened with Stagecoach, and it slowly just got worse and worse and worse, and then they had to backtrack a little bit, right, and get back on just focusing on the UK business.
I think a lot, yeah. They had to backtrack. I mean, they were trying to scale this thing, Scandinavia, Hong Kong, New Zealand, the US, and it just wasn't working. The cookie cutter approach just wasn't bearing fruit. So, they brought the founder back and said, hey, right the ship.
Figure it out.
And he did.
Would you guys consider that a turnaround situation, where possibly, because first of all, it's amazing that a business that's going downward, you can bring in an old guy and he rights the ship. That's pretty unusual. So I don't know what you guys' thoughts are on that. Because
sorry, CJ, you go ahead.
Yep, I was done.
I was just going to say, I think it's a turnaround when you look at it at the overall business level, but in some ways it's not, because it sounds like the core original business was still sort of performing well. It's kind of just, what's the Charlie Munger quote that was in that letter? Like cutting away the cancer or something?
That's the surgery approach.
That's the surgery approach. So it's getting rid of all the bad stuff. And I don't want to downplay how tricky that probably was to sell off businesses and probably fire people in the process and so on. But in some ways, I think that probably is an easier job than taking a mediocre business like, what's up, like say what Sergio Marchionne did with Chrysler, for example, and turning around an actually poor business that was underperforming. I'd argue that that's probably a lot more challenging.
Yeah.
What do you guys think about that?
With both the investments, say Costco and Stagecoach, they both have this underlying theme, which is easy to understand but hard to actually operate. I feel like he tried to get that theme across both the investments that he was talking about.
Right.
Do the simple things right.
That's right. I think a little bit about, and I haven't gone too deep into Apple and what happened when Steve Jobs left and when he came back, but that's kind of what that made me think of. Apple kind of, they got off course and Steve Jobs came back and he's like, okay, we're going to get back to simple and do this thing really well. This is our bread and butter. So that's what I think about.
Yeah, it seems like this is more of a, as Pabrai put it, like a focus mousetrap approach. So focus on the one business. But in the same letter, he talks about how there's always a main business that kind of spawns other businesses. I think the spawner framework came initially from this first letter, this 2002 letter. He talks about how there's this one jewel at the heart of a business, which can, produce the cash flow that you can invest into other spin-offs and anything else. I think that's kind of where the spawner framework really started from. Is that something that came across? It's on page 18, if you guys have it.
Yeah, the whole spawner framework's interesting. It's sort of like it's almost like these little VC style startups that businesses are trying to kick off, and clearly sometimes it works very well. Like you have Alibaba start Taobao, for example, and like that becomes the main business for a very long period of time, or still probably even is today. But then other times you have this the Stagecoach situation where it just flops. So I don't really know what to take away from that.
CJ, what are your thoughts about the whole spawner framework? And
I think it's a very interesting concept. Basically, I would just translate it to look for long-term compounders. And for me, it's hard to get over the hurdle of maybe retroactive fitting of, you look at Facebook, but when Facebook IPO'd, did we know that it was going to be a spawner? But now we can see that clearly it's got some characteristics of a spawner. So that's my main hang up with the spawner framework. But I mean, if you can find a business that's selling cheaply with those characteristics, then obviously it's got to be a no-brainer. But you have to have a very keen mind. I think Pabrai is capable, so that's why I'm always looking forward to his insights for those.
Are there any companies that you see that kind of fit this framework, or in your own portfolio?
Well, I think Alibaba is definitely one, but I don't think that's any shock or surprise to any of us here. They are very rare. I mean, that might be the only one in my portfolio right now, to be honest. Few and far between. I haven't looked into Shinnikin much, although I believe that Pabrai thinks that's a spawner as well.
Yeah, interesting. It seems like there's something that there'd be a lot of like survivorship bias in, right?
Yeah.
There's probably for every Alibaba and Facebook and Amazon, there's got to be hundreds of stagecoaches that didn't get turned around. Brad, I know you've done quite a bit of work on survivorship bias, so you've put up a few videos on survivorship bias. Did you have any thoughts on how that sort of fits into the whole spawner framework? Or even something like the 100 bagger, 100 baggers by Chris Meyer is a classic. Like he's got a big survivorship bias disclaimer right at the front of that book,
Yeah. Yeah, I mean, I think it's the main source of skepticism that I have when I look at a book like 100 Baggers or 100 to 1 in the stock market. Yeah. I mean, you're not seeing the graveyard of companies that, may have looked like those 100 baggers in the early years and just aren't around anymore to examine. So I think it's a huge issue. And I think it can't be overstated enough in terms of needing to be aware of it. I think that's partly why Chris Meyer seems to focus on, in his book, he said, these 100 baggers at the beginning, they were sort of a 500 million market cap company to kind of begin the journey to 100 baggerdom. And he doesn't own anything under like 2 billion in market cap. So I'd be interested to ask him that. But my sense is he wants to see a company that has proven that they have this long-term compounder kind of DNA and he's willing to give up some of that extra potential gain to have that peace of mind, that certainty that, all right, this thing, has legs. And there's probably some wisdom to that.
Yeah, that's smaller. Yeah, go ahead.
No, all yours, Karan.
Okay. With a lot of smaller companies, one of the main risks that people, I think, don't account for is the risk of getting acquired. Because if they are great businesses, they are spawners, there are going to be other capital allogators that recognize that and get on it. They're going to merge those companies quickly. I don't think people really account for that as much. I'm sure Frank would probably have good insight about that, since he kind of focuses on the microcaps.
Yeah. Now, I haven't really, I don't think I've owned any companies that have been acquired. Well, isn't there potential upside in that? Because usually they're acquired above, the current market price. How do you see that, Karan?
So let's take our favorite example, Heritage. Right?
Yeah.
If someone was to go ahead and put in a bid, or Eddie Lampert decides to take it private, we lose out on all the potential upside that we could have at ridiculously low prices relative to now. So,
right.
These are the best.
Yeah.
Yeah. So you get sort of the short-term pop maybe from someone comes in and pays a 20% premium to the current market price, but you miss out on a, potential home run, a few years out. So
if it survives.
One of the other things that I found quite interesting in Nick Sleep's letter was how he spoke about the market value of his portfolio versus where he saw intrinsic value. Right. I think in the first letter he spoke about, he thought it was a very specific number. I think he said something like, I think my portfolio is trading at 51 cents on the dollar or something.
Yeah.
Have you guys ever performed that sort of analysis on your own portfolios? Because that's actually a thought that has gone through my head fairly often, as I have, when I have, say, quite a few new stocks in the portfolio, I might think my portfolio is trading at 60 cents on the dollar or something. But, as I've had some investments where the thesis has started to play out, it's almost like that gap is sort of narrowed and we're getting closer to 100 cents on the dollar, which is great because the investments have worked out, but it's also presumably means there's lower returns moving forward because you haven't got this big gap. Ideally you want to sort of be at a big gap to intrinsic value at all times to get high forward returns, but at some point I guess the investments do have to play out, I suppose. I'm just interested to hear if that's something you guys have thought through before.
Yeah, I haven't done that. And, it seems like the framework for that is, when you buy a 50-cent dollar bill, you're hoping it converges with kind of a static, in a sense, intrinsic value, and then kind of moving on to the next thing.
Sure.
And I think that's where Nick Sleep started out. Like that was his thinking, and that's kind of where this comes from. But I would guess, I don't remember exactly at what point, but I guess a few years in, he probably stops referencing that because he's looking at maybe holding these for the long term. So that's my thought.
Yeah, so it doesn't account for any growth in intrinsic value,
right.
Basically. Yeah.
Yeah.
Is this something you've thought about at all, CJ?
Not really. Brad brought up a good point that I like to see the needle continually moving. So, no, but I don't know. For some reason, I just have only focused on the individual positions, but the portfolio as a whole. No, that's an interesting thought, though.
Yeah, for sure. I'm completely blanking on the name, but Toby Carlisle had someone on his podcast a few weeks back talking about this exact concept, actually, and he used to put it in their investor letters, and every few years they'd go back and look at how predictive that price to intrinsic value estimate was of forward returns. And over shorter time frames, as you probably expect, it was not that predictive, like if you were looking over 6 months or a year. But when he was looking out 3 or 5 years plus, it was actually a very predictive metric, even though it was, of course, just an estimate. Like intrinsic value is not a figure you can obviously look up on a financial statement or anything, but it turned out to be quite predictive. Again, I'm blanking on the numbers, but I quite like that idea. I wonder why Next Sleep dropped it. Maybe it was just this transition to compounders.
Yeah, sounds like they were pretty good at estimating intrinsic value.
Yeah,
right?
for sure. Or the market had like stocks only go up, and
that could be.
It worked out.
Right. How about you, Karan? Do you use any kind of metric like that to keep track of the overall portfolio?
No, not really. I mean, I think I'm moving more towards Guy Spears' approach of looking at your portfolio less. So think about it less. Like, do the upfront work, think about the business, and then let it just sit. Yeah, I'm working hard on getting there because I personally do look for 50-cent dollar or discounted price, but it makes more sense to move into the other approach and just buy Alibaba and sit for the next 10 years.
So you're working hard towards inactivity. Is that what I'm hearing?
Yes.
Perfect.
I don't think the people who are invested with Unito are going to be happy to hear that, but
no.
I was actually just about to ask you that, Karan. How do you get a lot of feedback asking you, saying "swing you bum" or something? Or
yeah, I've actually started consolidating the portfolio into started concentrating the portfolio into the highest conviction ideas and kind of just sticking with them rather than the 6 months and 12 months and we're going to be getting this great return.
Yep.
Well, you'll have to start writing a quarterly letter, and in the last paragraph, you can keep reiterating why you're not swinging, right? Help educate.
I still have to make the monthly update videos.
That's it.
That's still going to be a thing.
They could all be 30-second videos of you saying, "Here's the numbers. I haven't done anything. See you in a month."
That was a plan for next month. It was like, yep, nothing's changed. Everything's pretty much the same. Refer to the last video.
Well, I haven't gotten to the later Next Sleep letters, but listening to Mohnish, it sounds like the Next Sleep letters start to get a little bit like that, don't they?
Yeah.
Has anyone read those later years where he was just heavily concentrated in three names?
I'm at 2005, 6.
Yeah, me too.
Okay. Yeah. Maybe we'll get to that, but
we will.
Yeah, hearing Pabrai talk about it sounds like Next Sleep, it's Nick and Zach, isn't it? We're saying, we've basically done nothing this year, and we think that's a job well done. So thank us later. We'll see you next year.
May we all get to that point.
Yeah.
I'm going to pop up a comment here.
I had something else I need to bring up actually in the letters.
Okay.
So with regards to Costco and Jim Senegal, in terms of the integrity of the management, is that something? I mean, what about that part? Is there something that made you think about how you would evaluate management, or have your thoughts towards that changed after the letter?
I don't think for me personally, I don't think my thoughts have necessarily changed, but it reinforced the idea of management integrity. And one of the ways I've tried to assess that in the past is basically just to go back a few years and say, what were management raving on about 3 years ago, and have they executed on that firstly? And if they haven't, have they, done something like Warren Buffett would do or like Next Sleep would do and said, yeah, we stuffed that up, but let's keep moving on? Or did they just try and put that under the rug and never talk about it? It reminded me a lot of those ideas.
Yeah. Yeah, it was pretty just sticking with, those core values of, hey, we're here to serve the customer. We're here to deliver, savings, pass on the savings to the customers. And that's our long-term growth plan. And there's that flywheel of savings lead to more revenue, lead to better negotiating power with suppliers. And it's just this long-term flywheel where the profits take a long time to really show up for investors. It's the same thing that Amazon has done over the decades. And it's a rare model, but such a powerful one when you find it.
It's compounding goodwill, right, with the customers.
Yeah, That's right. I'm going to pop that one up here.
Yeah.
After dinner investor, our buddy, should we look at restaurants or retail as spawners if they're growing store count across the country? So, I think of Domino's, I think of Chipotle, things like that. Are those spawners? What do you guys think?
No, I view spawner as new lines of business generally, not growing existing lines of business. Oh, I mean, maybe you could look at McDonald's launching a breakfast menu as a spawn, but I don't think McDonald's growing its store count as a spawn, if that makes sense. That's how I would think about that.
McDonald's investing in Chipotle would be kind of a spawn.
Yeah.
Yep.
Yeah.
Yep.
But I think just growing the current business, I wouldn't classify it as spawning. I mean, at the end of the day, like if you've got a Costco or a McDonald's or a Domino's and you can just run that compounding engine for a long time, like who really cares if it's a spawning of a new business or not? Like it's working.
Each individual franchise has a lot of power. So
yeah.
I think retail and restaurants both are more focused mousetraps. Like they're more like they develop within, they innovate within the business. It's not that they have unrelated or related diversification as such.
Yep.
Yeah.
what about a company like Yum Brands that owns several different KFC, Taco Bell, things of that nature? Would that fall more into the spawner category for any of you?
Still food. I mean, still the same stuff. Yeah.
Yeah. Are they, I haven't looked much at Yum Brands, but are they, well, they mustn't be starting these things. They're acquiring.
Right. Yeah, they've got to be
Really?
acquiring them.
Yeah, it's more of the Berkshire Hathaway model, I suppose, but more focused on
holding
food.
company.
Right? Yeah.
Yeah,
and then, sorry, you go, Brad.
I'm going to talk about something unrelated. You can finish the thought here.
It's escaped my brain, so you go.
I was doing a little research on Domino's a little while back and looking at the performance over the last decade. I mean, it's been an 18 bagger over the last 10 years, 34% CAGR. I think it's done better than Amazon. So, a simple business like that, if it's executed, with incredible attention to detail and cost savings, can just kind of produce mind-boggling results.
Yeah, and they've had both the two sort of 100-bagger, things working in their favor with earnings growth and a lot of multiple expansion. So you get that double whammy of return.
Right.
I think with restaurants, a new thing that they're doing with the cloud kitchens and ghost kitchens, I think that's kind of the new wave of kind of, I don't know how you would call it, but like, when in phones, like they have phone cycles, like I think that's like the new cycle that restaurants are going to be using to grow their business in the future. Are you guys familiar with the concept of cloud kitchens?
Not really, no.
Mm-hmm.
So rather than opening a
us.
new storefront, so there's this podcast, Business Breakdowns, where they go through Chipotle, and that's kind of where I got the idea from. So if a restaurant wants to kind of try out a new market, rather than going and opening a new restaurant with a physical space, you could just go out with a cloud kitchen, have delivery only, and kind of test the market. If it works out, great, you can get into the market a bit more, but yeah.
Right. So it's just a bare bones kitchen. You don't need to have the seating space or any of that other overhead to get started.
Correct. Yeah. And suppose you're a company like Yum Brands, you can have multiple restaurants, basically like KFC, Pizza, and so on, everything in one kitchen, and then just deliver it from that one kitchen.
Yep.
Yeah. Great way to try new concepts, new ideas. You can launch an entire restaurant that's delivery only. I don't know. It's an interesting model. I think the guy who founded Uber is like completely in this right now.
Yeah.
Yeah. I like after investors comment here. Grew up in a ghost kitchen.
Let me see if I can.
I thought you were looking at his Domino's comment.
Little shout out to Will Ferrell there, huh? You guys, I don't know if you've done much on Twitter with the GIFs. I go down this rabbit hole with finding the perfect GIF. It's so much fun. I love that that's a part of the Twitter experience.
What would you say is your average time spent per GIF posted?
It's actually pretty quick because it's so good at finding the perfect one for me. I scroll maybe a couple screens down, but it's pretty quick.
Yeah. Is it actually quick though, or is it like TikTok quick where you go to spend 5 minutes on TikTok and 3 hours goes by?
It's possible that it's the latter.
Okay.
I don't know.
Okay.
Yeah.
Don't download TikTok. It's a disease.
But where else do we get our financial advice from?
Yeah, good point.
Brad, it's the one place I've seen Charlie Munger and Will Smith in the same message.
Right. Yeah, that was a recent one. You caught that. Let's see. I'm looking at other comments here. Let me know if you guys
usually ask our audience if they've read Nick Sleep's letters.
Oh yeah, we should do that. Let's poll the audience. If you guys have read Nick Sleep's investment partnership letters, even if it's just 1 year, let us know in the comments. And if you haven't, we'll give you a little slap on the wrist. We can do that.
We'll include a link to the letters, I think, in the description.
Yeah, we should. Mm-hmm.
People can.
We should. I guess that means me.
Iggy. You're Jack this week.
The Iggy Foundation, which is his nonprofit.
Yeah.
Did any of you feel like you were reading Warren Buffett when you read these early letters? I just felt like he talks about the exact same things. He's as transparent as Buffett. I mean, I don't know. I would have loved to have him as my manager. That's for damn sure.
Yeah, I mean, I think he got a lot of inspiration from Buffett. I don't remember. I think he even has it in the letters or maybe it's in the book, Richer, Wiser, Happier, how, they went to the first Berkshire Hathaway annual meeting and it was just like this whole new world that opened up that they were kind of missing in their previous investment career. So he was a big inspiration. And I love that the partnership letters start with the kind of exchange of letters between Nick Sleep and Warren Buffett when he decided to shut it down. That was cool to see.
Yeah, and you're right. The way he sort of speaks to investors is very reminiscent of particularly the early Buffett letters. Like if you've ever read the 1950s partnership letters, I mean, even the way he categorized some of his investments as workouts is exactly what Buffett did in some of those older letters, right?
So we've got, we're just going to keep going with After Dinner Investor because he's really pitching in here. Are there any spawner examples other than Amazon and Alibaba? Absolutely. What have you guys got off the top of your head for spawner examples?
I was just going to say yes and then hand it over to you guys.
Well, we mentioned Facebook, I think, is a cloner and an embryonic, I think. And they also acquire businesses as well. Microsoft.
Tencent comes to mind, Microsoft.
Berkshire are more of an acquirer of businesses, but they were in Pabrai's list, at least.
Yeah.
And if you want to go down that rabbit hole, you could probably add things like Markel to the list, or hey, Daily Journal Corporation's a spawner. They're starting a software as a service business, right? So,
yep. In the 2021 free lunch portfolio on Pabrai's blog, he lists the 5 spawners that were included in the last batch. So Berkshire Hathaway is actually listed as one of them. Restaurant Brands International, which gets at our last discussion about restaurants. Starbucks, Microsoft, and Brookfield Asset Management. So it seems like his definition of spawners is perhaps more broad than what we're speaking about here.
Chamath?
Sorry, yeah.
Chamath.
Oh yeah, of course. Greatest spawner.
There's no way to invest in that yet, though. And I don't know if anybody's going to want to after... who was it that totally roasted Chamath? Bloomstrand.
Chris Bloomstrand. Yeah.
It's brutal.
Yeah. R.I.P.
Yeah.
I've mentioned this in the past, but I think Palantir could be a spawner.
Uh-huh.
Yeah.
Yeah.
I mean, just looking at the way they're investing into. So I don't know if you guys have looked into their Skywise business. So they have this partnership with Airbus where they developed this new platform to kind of improve, like simplify the entire supply chain of the airline industry. And through that, they've been making other investments. And that's in a new SPAC. I mean, it sounds very speculative and everything, but for a company to actually work on its area of expertise, invest in those businesses, seems like a spawner to me.
Mhm.
Obviously, you have to get it at a reasonable price, which is a whole different thing.
Who knows what that is, right?
Yeah. What about, you
After
guys?
dinner investor just said it. Uber. I was about to say that. Uber Eats, the
Sure.
cloud kitchen
Sure.
concept.
Yeah, I was just about to ask Karan if he saw Pershing Square as a spawner.
Yeah, I mentioned that also. I mean, that I think is a very obvious spawner because it's literally spawning out SPACs, new deals, new companies, bringing companies from the private market to the public market.
Mm.
Yeah, I think that's like a obvious spawner.
I'm going to take a question from Frank here. CJ's thoughts. CJ, we're going to put you on the spotlight, and everyone else. Investing across different sectors, would you be willing to be concentrated into 50% into just one sector, tech, for example? How do you diversify across sectors, or how do you guys think about diversification across sectors?
I personally don't really give it much thought at all, to be honest. If I think I understand the business and I think that the chances of me losing money in that business are 0 to extremely low, then I don't care what sector it is in, basically.
Yep.
Yeah.
So yeah, I'd be
What
willing to have
CJ said.
50% in one sector.
Same ditto. Yeah.
Would you be willing to be 100% in one sector?
Yep.
Yep.
What's the highest allocation that you've had in any one high conviction idea?
Post for initial investment or
Yeah, I mean, either on a cost basis. On a cost basis.
cost basis. Probably about, I think 25 or 30%. So I mean, yeah, nothing too wild in my opinion, but
I think that's like around where we all
Yeah.
are.
Mm-hmm.
Yeah.
Karan's not saying it, but he's like, CJ, that's chump change. all in, baby.
Well, yeah, 30-40% is a good number.
Yeah. Yeah. No, I'm in the same ballpark as CJ on that one.
Scotty, do you know if Nick Sleep took considerable time to write and craft each letter like Buffett does? I haven't actually heard the backstory about how much time Buffett spends. Do you guys, Tom, do you have a sense of that? I know you follow Buffett pretty closely.
What's her name? Carol Loomis has talked about this before.
Mm-hmm.
And yeah, supposedly he starts putting the letter together like basically straight after the previous letter comes out.
Uh-huh.
That's what I've heard.
I imagine it's something like a scrapbook where throughout the year he kind of pulls things that are relevant and puts it together at the end.
Yeah, I mean, yeah, who knows really, but
Yeah.
that's what I've heard through the grapevine.
Okay.
Yeah. But presumably Nick Sleep's doing the same thing if he's just got the feet up on 3 stocks after a few years.
Yeah, he's got time, right?
Hmm.
So here's one. Can we talk about sleep investing in Zimbabwe and Thailand? What did you guys think if you came across that? I don't think it was in the first year, but the currency risk with Zimbabwe and some of these other countries. Do you have a take on that? I mean, I immediately think of Pabrai investing in Turkey and how, they could be operating in seashells. He doesn't care. Curious if you guys have thoughts about that.
Zimbabwe is later, right? Isn't it? Thailand is here, but Zimbabwe is it.
Yeah.
I remember that being covered in Richer, Wiser, Happier.
Okay. Right.
What did they say in Detroit?
I'm blanking on the exact details. I'm trying to remember what type of company it was in Zimbabwe. Was it a cement company or
Yeah, right.
something like
Yeah.
that?
Mm-hmm.
I'm blanking on the name too, but yeah, it was a cement. On the Thailand investment, I think the business that he found, I think again, he was also like Pabrai, just kind of focusing on the business and how dominant the business is. The founder led, the owner orientation. I think that was the focus. It wasn't as much about Thailand in the focus.
Mm-hmm.
Is this the newspaper company that was selling for 3/4 of sales or something like that? Okay.
Matichon.
Yeah.
No
It's
more
interesting
thoughts
that he
on-
was even looking in Zimbabwe. That's just not one of the common hunting grounds. I don't even know if I can invest in Zimbabwe, so it might just be off the table immediately.
Yeah, I think
I probably
that's
wouldn't have
something-
done it though.
Yeah. But I think that's the idea. They're going for the illiquid positions that are small caps, so they can really get the outsized returns.
Right. Karan, question for you. When you put on these large at-cost positions, what % are you able to contribute new capital relative to portfolio?
It's still a process that I'm thinking about because it's come to a point where the new contributions don't have an effect on the overall portfolio. So I'm trying to figure that out on my own. So
TBD.
yeah.
Well, we've got a question about tracking annual returns if dollar cost averaging on, say, a monthly basis. How would you track your returns over time?
This is going to sound like a plug, so apologies if it does. But
I'm plugging.
Yeah, I just use ShareSite to calculate it because it's really hard to calculate if you're constantly adding money to your portfolio. It's not like if you start 1st of January with a fixed dollar amount and then end of the year without contributing or pulling out any money. That's really easy to calculate an annual return. But if you're putting in random amounts of money in like every month, it's very complicated. So, yeah, ShareSite was started in New Zealand and I just used that.
Tom, do you have a discount code for ShareSite?
I knew this was going to, we didn't arrange this, people watching. I
this
do.
is so awkward for you, Tom.
Yeah, I feel too salesy if I just tell you my discount code. If you really want to check it out, it's in the link it's in the description of all my videos, so I'll give you that.
Good. Anything else in the markets that you guys are seeing that you want to, bring up and powwow about?
I'm looking at
Well-
Pinduoduo.
Uh-huh.
The first interest was as a competitor of Alibaba, and secondly because Lilu is also has a small but a position nonetheless. So
Sure.
that's what I've been kind of digging into.
Yeah, go ahead, Karan.
CJ, do you have any thoughts about Taobao deals versus Pinduoduo?
Um,
The gamification initiative.
I think-
that Alibaba has.
I defer this opinion to Lillian Li, who's an excellent analyst of Chinese tech companies, and she says that it might be a little bit too little, too late for Taobao deals. So I'm just going to go with that assumption. I don't think it's going to be nothing for the business, but it's probably not going to be able to overcome Pinduoduo. I mean, they just passed Baba's active yearly users with their app. So, I mean, it might be hard to claw some of that back, a lot of that back at least.
I think the core business of Pinduoduo seems a lot stronger in a way, isn't it? Like the e-commerce at least. Yeah. Sorry, Brad, you were thinking.
Yes, CJ, I assume you listened to the Investors podcast with Stig, kind of talking about Pinduoduo as one of his 2 or 3 potential investments for 2021. Did you listen to that one?
I have not listened to that. I listened to the business breakdowns episode actually.
Okay.
Awesome.
Yeah,
They had a couple weeks ago.
that's one he referenced. That was pretty good. I think it was like 2 hours, right, just on Pinduoduo.
Mm-hmm.
Yeah, and I found out, I think through that the founder of Pinduoduo had lunch with Buffett the year before. Mohnish Pabrai and Guy Spear had lunch with Buffett. Which I was like, that's interesting.
Yeah.
And I tweeted that, and Guy Spear didn't know that, so that was kind of fun. Yes.
Winning.
Teaching the masters. There we go.
Yeah. Anything else? Any questions you guys have? Pop them in there. Any questions that you three or us four have to throw out there, just to bang around?
How's your magic formula portfolio doing? Any other IDTs?
Any other what?
IDT? Potential IDT?
Potentially. I don't know. We'll have to wait for Connor's next quarterly high conviction bet. It's performing well. It was actually Jesse who ran like a XIRR on my magic formula portfolio versus the S&P 500. I guess I'm not doing as well as I thought I was, but the 5 that I bought a year ago are, I think, up 65%. So compared to the S&P, which is up, I think, 42% or something, which 42% for the S&P 500, that's like better than any year since the 1950s. It's just insane for 500 large caps to be doing that kind of performance. So it's wild times that we're in.
Mm. Can we talk about Ted Weschler's IRA?
Yeah,
Do you guys see that?
You've probably done the biggest
Tom, go
dollar
ahead.
on that one, Tom.
Yeah.
Well, it's hard to do more work on it because there's very limited information. But by my maths, he's cranked out like 34% a year for 29 years in his IRA. And actually, that was actually before accounting for a big tax hit that he paid when he converted it from an IRA to a Roth IRA. So the compounding rate may well be higher than that.
No, I didn't look deeply into this, but doesn't that assume no contributions in that 29 years?
That I was assuming $6,000 a year contributions,
All right.
which I'm not from the US, but my understanding is that's the max. I don't know what it's been over that full 29-year period, but I just assumed it's
in
about
order for him to have that starting amount in there 29 years ago, I mean, it couldn't have just been those 6,000 contributions. There must have been some kind of loophole, I would think, right?
Well, the starting number, or the number kind of a handful of years or so into his career that they gave was like 60 or 70 grand. So I think he could have got there. Yeah.
Sure.
But that's obscenely high rates of
The
return.
contribution, the end result is insane.
Yeah, it's unbelievable.
Now, I wonder if that was you can do like a self-directed Roth IRA in the US. I don't know if you guys are aware of that, where you can invest in, things outside of more traditional investments like public companies. You can invest in real estate. I think you can do private equity. You can do things that you can't typically do in an IRA. So I don't know if that was part of it.
Yeah.
But.
So the other person that was included in this article was Peter Thiel, and he did do a lot of that stuff. So his IRA is more ridiculous. It went from $2,000 to $5 billion. And he was doing a lot of that kind of stuff. So Ted Weschler was given a heads up that this article was going to get put out on him, and he actually wrote like a one-page statement about the whole thing and gave a few more details. And yeah, he specifically said the account was only ever invested in publicly available securities that anyone could have bought. So mind-blowingly good returns.
There's no 13F for that account, unfortunately. You can't see what's happening.
No, I would.
Sorry?
Berkshire's in safe hands. Yeah. Look, I mean, if anything, if if anything, it's prompted me to pay far more attention to the smaller stuff in Berkshire's 13F, because I've been very guilty of just paying attention to the top 10 and seeing what Buffett's up to. But yeah, I'm going to look a lot harder at the small things now. So it's just, I actually had a comment on that video saying 33% is not that impressive. Which,
on the video you just put out?
On the video I put out. So
can you get that person's info? I want to invest with them.
Yeah. So I had a lot of thoughts on that comment, but I held back.
You want to invest in the crypto portfolio, like?
Yeah. It wasn't. I don't think it was a spam comment. Like, it was. They had. Not very spammy, you know, their reasoning written out and everything. So, 33% a year is ridiculous. You'll take over the world if you do that for too long. So,
yes,
very impressive.
Yeah.
Is anyone familiar with Weschler and Combs' returns for Berkshire to date? I don't know if that's very transparent, but I haven't really looked into it. So.
It hasn't ever been listed explicitly, but there was a question at a Berkshire meeting maybe 2 years ago, and Buffett said that they'd basically matched the S&P 500 up until that point.
Okay.
He did go on to say they'd done better than Warren had done, but that basically matched the S&P. Yeah.
Which, you know, for Berkshire's approach, that's fine, right? As long as you can kind of gain a little ground when the market is down or flat. I think that's perfectly reasonable.
Yeah. He did do also like 26% a year in his fund over about an 11-year period pre-Berkshire. That's Ted Weschler specifically. Not sure on Todd Combs. So
impressive stuff.
Question for you, Tom. Are New Zealand's IRAs capped in terms of annual contribution?
Yeah, so our retirement accounts are called KiwiSaver. Much cooler name, I reckon, than an individual retirement account.
I agree.
So you can choose to contribute. I think it's either 3%, 5%, or 10% of your income to that account. But the investing options are very limited. So basically, you can, if you know what you're doing, you just index it. Otherwise, by default, it gets put into terrible mutual funds charging 2% management fees and stuff. So you can pull out that money when you want to buy your first home or when you turn 65, and your employer matches up to 3%, I think. So for me personally, I just contribute the lowest, which is the 3%. So my employer matches that amount, and then I don't contribute beyond that because the investment options are very limited, and I can't touch the money till I'm 65 if I want it. So that's the situation here.
And is that invested in like an S&P index, or how are you investing that, Tom?
So mine, so it's indexed basically, but it's spread. It's spread, I think, between New Zealand, Australia, and then like a global equities index of some sort. It's basically 90% shares of some sort in some sort of index like that, and then I think 10% in like fixed interest bonds and things. That's as aggressive as I can possibly make it with low fees. So
gotcha. Cool. After dinner, you must not have been here at the beginning. Jack is partying tonight at a wedding, but he's not drinking. I don't believe Jack drinks, just like Warren Buffett. You know, he tries to stay clean. So for what that's worth.
Yeah, he does. He did put a video out recently about making an offer on a property, though, so that's exciting for Jack. I wonder what Jack's dance moves are like at the wedding.
We should have him record a YouTube short or something to throw up on Punch Card.
Yeah, I really enjoyed his monetization video. Did you guys see that? Of him reaching 4,000 hours of watch time. That was fantastic.
He got dislikes on that video. How?
Yeah.
Yeah, there's no explaining the dislikes sometimes. It's just, it comes with the territory. Yeah. Anything else, guys? We've got 1 or 2 minutes left, but anything you want to throw out there?
I'll just quickly answer Luis's follow-up question about something about a top 50. So that refers to a New Zealand top 50 fund investment that I made pretty early on, and I still have just hung on to. So that was outside of retirement accounts. That's just me putting money into sort of a S&P 500 equivalent in New Zealand, which is a New Zealand top 50 fund. So that's what that was.
Hopefully not like the Nifty 50.
I hope not. It's very concentrated, the New Zealand top 50. Like, I think 30%'s in the top 2.
Wow.
Or at least it was like that last time I checked. That was a while back, though.
Yeah.
Brad, the Indian index is also called the Nifty 50. So
I see.
that's why it's like,
Yes.
okay, yeah.
That concentration kind of sounds like the situation in South Africa with Naspers. They've got a huge concentration on the
Right.
index.
Yeah. I thought of Naspers when you guys were talking about that.
Yeah. Have you guys looked much at Naspers?
A little bit.
Starting to dig in.
Yeah.
Anything interesting / open to sharing so far?
Let me just hit this one first. We missed this last time. Sandeep, my question is about investing in a portfolio which has only the top 10 most invested stocks from the top gurus. So if you look at Dataroma, right, most of us have seen the Dataroma website. It shows the top 10 where there's the most super investors invested in those companies. And the idea is, what if you just mimic what those top 10 are in a portfolio? What are you guys' thoughts on that?
Seems legit.
Yeah, I guess the concern I have about that, I would imagine a lot of the companies that have made it to that top 10 have run up in price quite a bit since a lot of those investors initially bought in. So that would be my big concern, buying in at kind of frothy prices. But if you dig into the price a little bit and you're able to assess, price to value, I think that could be an interesting way to go.
Did Dataroma have?
Yeah.
Did Dataroma have any sort of like index, like super investor index they track or anything like that? That'd be interesting to see.
By amount of conviction, so the highest portfolio allocation that a super investor has to any particular stock, you can filter it.
Yeah, but they don't have like, if you just copied this question saying if you just copied the 10 most bought stocks for the last decade, this would have been your return. Like they don't have a super investor index or anything like that.
I don't think
That's
so.
there, right? On the front page, the companies that are most picked up by super investors. I think Facebook,
Yeah, I think
Micron, they all show up.
Tom is wondering if they've tracked performance. Is that right, Tom?
Yeah. So if you just copied the most invested stocks, what returns would you have gotten over a time period?
I haven't seen anything like that.
Okay. Yeah, that'd be interesting to put together.
Yeah.
I guess that's kind of what Pabrai's trying to do with some of his what's he call it, his free lunch or shameless cloner portfolio.
Free lunch, yeah.
Yeah, it's interesting. It's like, I really like the idea of cloning, clearly, because I've done a fair bit. But it's, I mean, the challenging part is choosing which investors to clone.
Right.
Because again, presumably you're going to be cloning people that have had really good track records, but potentially some of it's luck, hopefully most of it's skill in the people we're following. There's a bit of that going on. Like there's that famous study of if you'd cloned Warren Buffett, these are the returns you would have had. But, obviously when you go and back test what happens if I copy the greatest investor ever, you're probably going to get pretty good returns. So it's like, how do you find the future greatest investors,
Right. It's how do you have a long enough track record that you can tell there's skill there, but not so much assets under management that it's dragging down the portfolio, right? It's a fine balance, I think.
And the trouble is you often don't find out, who's got skill until they're 40 years down the track or something, or 20 years in, and then they are managing lots of money and you can no longer clone them. It's like Yeah, they sort of keep, just as you figure out that they're great, they sort of drop off. So you're constantly chasing these good investors.
That's right. If any of you get dislikes on your videos, just remember this comment. It was an accident. It's not you. It's the like button. All right, guys. I think that should wrap it up for today. Thank you all for being here. CJ, thank you for coming on in such short notice. Hope to have you back at some point in the near future. And yeah, thanks everyone for watching. All right, take care.